All right. Hi, everyone. It's Meet Cindy it's Cindy from Meet Cindy. So today we have David Hunter here. He's a chief macro strategist with over 40 years of experience on Wall Street. His Twitter handle is Dave H. Contrarian. So if anyone wants to reach out to him in regards to his investment letters, go ahead and DM him on Twitter. Let's welcome David.
Yeah, hi, Cindy. Thanks for having me on.
So David, want to share with us some of your views on markets, trends, real estate, and even commodities?
Sure. I'll start probably with the stock market. I have been probably the biggest bull on Wall Street over the past 18 months. Back in the March 2020 lows, I started talking about a melt up as where we were headed. And I've stuck with that call all the way through this last 18 months. And my view is that we're going to see a final parabolic move up, a final leg to this bull market. I call it a secular bull market that started back in August of 1982. So a 39-year bull market, secular bull market, and I think it will end in a parabolic melt up. So I think we're in that last leg. I still think we probably could see a pullback one more time before we really get going into that last move. But my target right now is 5,300 on the S&P, 42,000 on the Dow, and I've got an 18,000 target on the NASDAQ, but I'll probably raise that. So the key is it's a melt up or blow off move. So once it goes vertical, you just really it could cover an amazing amount of ground in a short time. So I think that's what's ahead in the next few months. I don't think we'll get there by the end of the year, but I think certainly first quarter we could get to the top. And then what follows that, in my opinion, is a bear market bigger than any we've had in the post-World War II era. So bigger than anything since 1929, essentially. So I'm calling for a 70 to 80% bear market that will begin, following the blow off top. And it'll be precipitated by a global bust, a global economic bust in the economy. So, people, the term bust gets thrown around a lot, and people use it with respect to the stock market and things. When I say bust, I'm referring to the economy, and I define a bust as something bigger than a recession, perhaps as bad as a depression in lots of ways, but more the speed of recession. So most of the damage is pretty much contained within 12 to 15 month time horizon. And that's what I think we're going to see probably beginning mid-year next year, because the stock market will lead that. So you'll make a top in the stock market and then followed, a few months to several months later by something that's pretty awful in the economy. And it'll be global. So it's not just the US, it's, Europe's going to be in big trouble. Certainly China has a lot to worry about in terms of their situation. And the reason why I think it's going to be bigger than even 2008-9 is because we've ramped up leverage. It was big leverage going into 2008. It's far bigger leverage today. We've got, close to 300 trillion in global debt around the globe. And we've got notional value of derivatives in the quadrillions. So those two aspects, everybody knows about debt, but I don't think they consider derivatives when they speak of leverage, but that's truly leverage on the system. And once that starts unwinding, it can unwind pretty dramatically and fast. So the central bank's going to have a lot on their hands in terms of trying to prevent a total collapse. And as a result, what you will see is massive monetary and fiscal expansion. The monetary being the faster way they'll get to respond to this. Fiscal will take sometimes weeks or months to deliberate, and get parties to agree on things, whereas the Fed and other central banks can be pumping money almost immediately. So you will see an awful lot of money created. We've just gone from 3.7 trillion to 8.5 trillion during this pandemic. I think you'll see the Fed's balance sheet grow to over 20 trillion in response to the bust, could even be 30 trillion. So I'm talking big numbers, and that will, with a lag, and it's going to be probably a 6 to 9 month lag, but with a lag, that will jumpstart a new recovery cycle. That new recovery cycle, though, will come not immediately, but within a couple of years will come with hyperinflation. And I think by the end of the decade, I expect that we will have retraced all of the interest rate drop from 1981, all of the inflation drop from 1982. So we were 15% long bond, 15% 10-year rates back in 1981, and inflation was up in the 20% range. We will be back at those levels again, and maybe higher by the end of this decade. So that's not a very pretty picture, and it means the next cycle is going to look very different than what we've had in the last 40 years.
You mentioned about the 70-80% drop. That's really big call. So what don't you think the Fed will like punch in and try to like pump it up again?
Yeah, like I said, they will. That's probably the easiest part of my forecast is how they will respond. Not just the Fed, but every central bank in the world will be printing money at a rate we have never seen before. They will be putting more money into the system than we saw in 2008-9, more than we've seen in the last 18 months, and multiples of those numbers, because they're going to be dealing with a system that's free falling, a financial system that's really unwinding. So no doubt they're going to respond. What I think oftentimes investors don't recognize is that it's not so easy as to say, okay, push a button and here's the amount of money we need. They're going to be putting in more money than they've ever put in, and then they're going to wonder, is that enough or not? There's a lag to when money actually stabilizes the system. So it's during that time where they're in this uncertain, unknown period where they have to just keep putting money in because not enough yet. Nothing's turned around yet. So let's say they'll put a couple trillion in. I'm just speaking of the Fed right now, but they'll put a couple trillion in, and it'll still be free falling. So they'll put a couple trillion more in, it'll still be free falling. So it's just going to take time, and it doesn't mean it's a straight line either. You could have bounces in the markets and periods of respite where it looks like they've done enough, and then a month later they find they haven't done enough. So I think in our world of communication, and the world where everybody's a trader, they think it's as simple as all they have to do is desire to do something and it's done. Is much more complex than that when you're sitting in Jay Powell's seat or Christine Lagarde's seat, and you're trying to figure out how much money do I need to put in? And of course there's offsets. What's going to be hard for them is we're coming through this period of inflation heating up. You can't, they're going to be tightening. That's what's going to, I think, precipitate the bust. And you can't just turn on a switch or turn on a dime and say, okay, now it's time to print money. The inflation's still going to be lingering for the first part of the bust. So they're going to be caught between a rock and a hard place in terms of, what do we do now? Have we done too much? Do we need to do more? It's just not a simple equation where you say, okay, we desire to stop this and we're going to print money. It sounds easy. It's not easy when you're in that seat.
Yeah, totally. Like Fed is stuck right now. Like, they have to either increase interest rate, taper, or let the inflation go hot, right?
Yeah,
Yeah.
we really haven't had that kind of a situation, or the central banks haven't had this situation for almost 40 years. One of the things that allows me to say things with conviction is I was investing as a pension fund manager back in the 70s and 80s. So I was there to watch what happened when interest rates all of a sudden went from 7 or 8% to 15%, because Paul Volcker said we're going to control money supply now because inflation's out of control. I saw how long it took to crank that down. I think today's investor, typically today's pundit, never wasn't there and never lived through such a time. We've been in disinflation for 40 years. So even the Fed is they're looking at the playbook from that back then and trying to understand it, but they weren't there then. So there's a few of us dinosaurs still around that saw that, but it's a different world.
Wow. Yeah. So what do you think? I mean, is the safest asset to be in them? Like, because this buzz is going to affect globally. Where do you put most of your portfolio in?
Yeah, I can't provide advice, but what I can say is that what I believe we'll see in terms of asset categories, obviously equities will be hit hard. Bonds will be, corporate bonds will be hit hard, particularly lower quality bonds, junk bonds, et cetera. Lower investment grade bonds will be hit hard because as the economy deteriorates, so do their balance sheets. And so, there'll be default risk, et cetera. The things that will hold up in the bust and in the bear market are going to be government guaranteed returns such as treasury bonds. I don't think we have sovereign risk this time around. I think we will after the next cycle, but this time around the central banks will have enough money. I mean, because inflation will be turning into deflation, they will have almost limitless ability to print money. So as long as the printing press is there, they can fund the FDIC, they can fund the government, so there won't be, at least in the US, any sovereign default risk. So treasuries will be one of the few places that I think will actually see increased value during the bust. So if the stock market is dropping 80% and treasuries are actually positive returns, that's a huge spread. I think the US dollar will be a flight to safety trade. I'm actually bearish on the dollar now. I think the dollar is going down before it goes up. But when the bust hits, and again, it's still many months away, but when the bust hits, I do think we'll see, as we have in past cycles, and in spite of people's skepticism about the long-term nature and long-term prospects for the dollar, I think we will see investors around the globe flee to the dollar because they still view the US as the most secure financial system. So you'll see appreciation in the dollar during the bust. So the treasuries and the dollar are really the two things that I think can buck the trend. And then obviously FDIC insured bank assets, savings accounts can be trusted to hold up as long as you stay within the insurance thresholds. As I said, the FDIC will be funded to whatever is necessary if we have bank failures, et cetera. I think we will have bank failures, probably more this time around. Last time it was very focused on the US. This time around, I think the bigger pain in the financial system is probably going to be elsewhere, because we had our banks, because they got hit so hard in 2008-9, their balance sheets are in better shape than a lot of banks around the world. So I'd be more worried about the European banks, the Asian banks, Australian banks, Canadian banks, because of the leverage in the system in those places. So it doesn't mean we won't have problems in the US banking wise, but I think it'll be less so than last time.
Oh, how about precious metals? Do you think that's a safer asset to hold? Mhm.
Yeah, I'm bullish on the metals right now. I actually have one of the more bullish calls on the street. I'm looking for gold to go to 2,500 probably in the next 6 months. It's before the bust, let's put it that way. So this cycle, and I'm looking for silver to go to 50. So those are pre-bust, peaks that I think we'll see. And then in the bust, they'll pull back. I don't think they'll get hit nearly as hard as the stock market. They might come back to these levels. So if gold goes from 25, goes to 2,500, it might come back to 1,800 type of thing. Silver, if silver goes to 50, and it might even go higher than 50, but if it goes to 50, I doubt that it gets back here. It might fall back to 25 or 30. I don't know. But it'll be, less than the equity indexes, I think. And then in the next cycle, because inflation is going to be so dominant a theme, with inflation going from what I think will be deflation in the bust, I think we'll have a fast, very swift decline in prices during the bust from negative inflation, say, in 2023, I think you can get to 20% plus inflation in, 7 years. So that will drive precious metals much higher. I'm expecting gold to be, who knows, 10,000, maybe 20,000. I'm expecting silver to go to 400, maybe higher. I'm expecting a lot of other commodities, and this is after the bust. This is next cycle. You could see oil at $400 a barrel. You could see copper at, which is currently, in the low fours, could be $20 plus. So a lot of big run-ups in commodities next cycle. So commodities and precious metals will be the leaders of the next cycle, like the social media stocks and technology were the leaders of this cycle. Healthcare was a leader of this cycle. They won't do so well in inflation. They do much better when interest rates are low and inflation is relatively low. So, and what we see, and I've done this, like I said, for almost 5 decades, and have seen many cycles. What you see is every cycle has new leadership. So the leadership of this cycle will be laggards next cycle, and you'll have new leadership. So the leadership next cycle I expect to be, commodities, precious metals, and industrial stocks.
Industrial stocks. Oh, okay. How about real estate? How will real estate fare during the bust and the hyperinflation?
Sure. Yeah, I think we're in the last stages of a run up in real estate. You can get, can probably be a little stronger here for a little bit longer, maybe into the spring. But following that, I think it'll get beat up in the bust. I don't know how badly. It's probably not as bad in the US as it was in 2008-9, but you can come off because there've been pretty healthy run-ups in housing prices. So I expect it to get hit pretty hard in the bust. And then the recovery after the bust, for a year or two, you could see a bounce, but ultimately you can have a very stiff headwind if interest rates go from, and I actually think the 10-year can get down to 0% in the bust. So although I'm calling for tightening here, that will drive the 10-year up to 2.5 in the next few months, in the next 3 to 6 months. From there, I think it can go down to 0. So you'll start from a 0 base on, and mortgage rates probably be down at 2% or lower. But you'll start there in say late 2023. But you'll see rates move towards double digits. And I think by 2026-7, they could be at double digits. And by 2029, you could be looking at 15% mortgage rates. So that's going to be a very stiff headwind for real estate. So everybody thinks real estate is an inflation hedge. Certain real estate will be. I think farmland might do well. because I expect ag commodities to do well next cycle. But
Mhm.
housing, I think in general, if you've got mortgage rates going from 2 or 3% up to 15%, you know what that does to people are buying houses on a monthly
Totally.
payment basis, and that's gonna drive the monthly payment up through the roof. So something has to give, and I think it's going to be housing prices.
Wow. I've never seen 15% myself. So
Yeah, we haven't had that since the early 80s. That was certainly, people back then had to adjust, and the markets do adjust. There'll be, flexible plans and things, but you can only do so much when rates are that high.
okay. What do you think will cause the big run up? And I guess what's the trigger and also what's the trigger for the bus? Because I think for such a big bus, there needs to be a trigger, right? Like a
Yeah, I think, trigger could come from overseas, but I think more likely the trigger will be Fed tightening. And as I said before, it's not so easy to say, okay, we have to tighten and we'll do a little bit of tightening, but we won't break the system. The problem is inflation doesn't calm down easily. So they're going to tighten, and there's leads and lags to that. So that tightening may go on longer than they would like, or than the economy can stand. And because we have fragility in the system due to the pandemic, I don't think it's going to take much to tip things over. So I think it's basically the trigger is likely to be Fed tightening, meaning not just raising interest rates, but pulling a good amount of money out of the system. And I just think that we've seen it every cycle that I've been doing this, that's usually what tips the economy. The Fed overstays the tightening because they have to, it's not like tightening and the response happen at once. The response comes many months later, and they always tend to overdo it because they think they haven't done enough yet. So as careful as they are, as much as people want to believe in yield curve control and MMT, I think they're going to find out that once inflation kind of gets out of the bag, it's hard to put it back in. So I think the Fed's going to have their hands full, and I would say probably second quarter of next year is probably the time when you're going to see some of the the issues really crop up.
Do you see hyperinflation the next few months?
I see inflation accelerating. I don't call this hyperinflation because I lived through the hyperinflation in the early 80s. Hyperinflation will be what we see second half of this decade. But I think we are going to see inflation accelerate from here. I'm calling for, I look at commodity prices for one thing, and my read is that copper right now is about 420. I expect copper to go up to $6 in the next 6 months. I think lumber is probably heading back to $1,000. It came off of what was it, 1,700 last year, and it fell to below 500, I think, and now it's starting to turn up again. I wouldn't be surprised to see lumber above $1,000 in the next 6 months. So those are just two indicators that I look at. And lots of other commodities, cotton and lots of commodities show, when you look at their charts and you look at the action, it tends to project for higher prices. So I think we are going to see higher inflation. I don't know what that will translate into in terms of PPI, CPI, but I think it's certainly going to be up 1% or more.
You mentioned on Twitter something in regards to China going to be the trigger for the it's going to affect like other countries. Do you want to mind explaining more about that, going more into detail?
Sure. The big reason why I think we're going to have this bust, which again, it's the worst downturn in the post-World War II era, worst downturn since the Great Depression. The reason for my forecast is the leverage in the system. We are we are in uncharted territory in terms of how much leverage is in the system. I quoted the numbers before: 300 trillion in debt and quadrillions in notional value derivatives. The most leveraged economy in the world is China. They went crazy this last cycle from the bottom in 2008 to where we are now. They just leveraged. Everybody leveraged up big time. They did it on steroids. So simply put, we saw a little bit with Evergrande. Simply put, their property market is is up on stilts and very leveraged. Their whole economy is very leveraged, their whole financial system. So even though they're a more closed economy than we are here in the States, they're going to find at some point that they can't control it all. It's not that easy. And so I think the odds are that they are going to play a big role in the bust. The conversation you're alluding to was somebody was getting into an argument with me because I said they probably won't be the trigger, but they will certainly play a big role. And he said, those are one and the same. I said, no, they may not trigger the bust. They may not be the catalyst for the bust, but once the bust gets started, their leverage is going to play a big role, as is the leverage everywhere in the world. So China just being the most leveraged is likely to be a significant part of the bust. That's all. It'll be, you'll see it in real estate. You'll probably see it in consumer. I would think you'll see it in their financial system.
Do you see China economy going down here from here on, or they will be the next superpower?
Yeah, that's a good question. I have drawn the analogy. It's a hard question to answer because a lot depends on how badly that unleveraging hurts them in the bust. But my gut is if I were giving you my best guess today, I think we are, and I don't know if this analogy will make sense to you, but we are where Japan was in the late 80s. Coming out of the 1987 crash, they went up to even higher highs in their market, and they peaked in 1989, and their stock market's far below that peak today, 30 years later. And so we are Japan, and I think China is where we were in 1989, late 80s, which means we went, obviously, our markets went way beyond those highs then, and and the U.S. has been a very strong leader in the last 30 years financially. I think that's probably the story, is that our market, I'm making the call that the secular peak that I am saying is within a few months of now, that secular peak in the stock market, those highs will probably not be seen for decades again, and maybe not even close. So if we get to, let's say even I have to raise targets again, and we get to 5,500 or 6,000 on the S&P, and then let's say we drop 80%, you can climb all the way out of that 80% drop and go from 80% of let's say 6,000 is 4,800 points. So you could go all the way down to 1,200 on the S&P in a bear market. I'm not saying we will, but these are just numbers to give an example. You could quadruple that 1,200, and it would take you back to 4,800, nowhere near the 6,000 top we got to, right? So you can have a big cyclical bull market next cycle after the bust and still be far below the old highs, and then work your way lower from there. So I think there's a good chance that the U.S. is going to be kind of in their twilight for a while China may continue to emerge as the world leader. Not what I want to say, not what I hope will happen, but I think that's kind of the more likely path.
I agree with you on that. Yeah. I even foresee, because, like what you said earlier, that Fed is going to print so much unprecedented money, even during the bust, that, they're not going to be able to pay off all these debts, right? And
Yeah,
so,
well, but that's the part that makes this a little bit difficult, is because
Mhm,
this is a global bust. The
mhm,
Fed is kind of the monetary leader, but believe me, every central bank is going to be printing at the same rate as the Fed. Not the same amount of money because they're different sizes, but pretty much to the same degree. So the People's Bank of China is going to be printing money at a big rate too. The only thing that's going to keep this system from collapsing is money,
mm,
because there's nothing else that can really come in. And people get mad at me and say, that doesn't work. That'll just create more problems. I agree, but I'm predicting. I'm not endorsing. I'm not saying this is good. I'm saying this is pretty much predictable, that the only response that they can um, pursue that's quick, that can meet the need, is monetary. So you will see it, and it's because of the leverage. The unwind is going to be huge, so the response has to be huge. But the U.S. is not in a vacuum here. It's going to be every central bank is going to be doing the same thing. So the problems are going to be worldwide. But I do think, for a lot of reasons, the U.S. has issues that are going to make them struggle more in the next cycle than China.
mm. So, how do you think the Fed, or sorry, the U.S. will have to solve this issue? I'm guessing you foresee maybe like a reset, or some kind, like economy currency reset. Do you foresee that?
I'm not in the reset um,
Mm,
uh, crowd. I think basically the dollar will remain the reserve currency for at least the next 5 years.
mm,
That doesn't mean you're not going to see digital currencies out there. You are.
mm,
It doesn't mean that central banks won't adopt some sort of, they'll be using digital currencies, of course. But
mhm.
I think the dollar will remain reserve currency for the next 5 years. Beyond that, my ability to see gets really pretty cloudy. So I think
Mhm.
certainly second half of this decade, later in the decade, anything's possible. The dollar by the time we get there is going to be in trouble because of inflation, and other reasons. So it's not that I have a long-term bullish view on the dollar, but I think there's a narrative out there that's very popular that reset is right around the corner. And unfortunately, I think people think reset is also, we're going to clean the slate and just
Yeah.
start over nice and easy. The that doesn't work. There's offsets for all that. You can't just wipe out the debt. There's people on the other side of that debt. So reset is not how this is going to happen. In my opinion, we get this recovery following the bust. It won't be, for some, if you're in the commodity arena, or if you're, in the areas that are beneficiaries of inflation, it'll be okay times, pretty good times. But if you're in other areas that get hurt by inflation, like housing, like consumer, um, it's not going to be so easy. And so it's not going to be a roaring 20s type economy. It's going to be, selectively, some areas going to be good and some not so good. And just new areas that haven't been good for the last 40 years. Commodities have had a long time of not doing great. The last year's been good, but so we'll have some areas pick up that haven't for a long time. But generally, it's going to be an uneven recovery. And then, unfortunately, because of that inflation, because of all the debt, how do you fund that debt? How do you finance? How do you service your debt
Mhm.
when rates go from zero, or from current levels, to double digits and high double digits? The equation doesn't add up. So unfortunately, I think we get to a place late this decade, early next decade, and this is, again, the U.S. is my focus, but this will happen around the world, I think we basically see a global collapse of the financial system. I don't have a very optimistic picture, view of what the 2030s and beyond look like, because the bust is going to be really painful, but the collapse that I think comes next decade, you're going to have unemployment through the roof, maybe higher than 50% in this country. You're going to have a government that's bankrupt, that can't finance welfare, can't finance Medicare, can't finance Social Security, can't. People don't understand that once you collapse a system, this is what I call a giant Ponzi scheme. This has been building for 5 decades or more, and has accelerated in the last 2 decades, and really will accelerate has in the last 2 years, and will right up through this decade. That you can't sustain this. You can't take on the debt we're taking on and then have inflation and interest rates go through the roof and finance it. It's impossible. So they can kind of play musical chairs for a while and take, to steal from Peter to pay Paul. But ultimately, within a very short time of a few years, it all comes to an end, because there's not enough money. You can, and if you say, well, let's inflate it away, or let's print more money to pay the service the debt, you create more inflation, which creates a bigger problem. You get yourself deeper in the hole, and you can't keep up with it. So ultimately, it collapses unto itself, and that's what I think the 2030s are about. So I tell people, focus on the here and now, because that's a long-term forecast that can be wrong, but that's how I see things, at least how this thing ultimately comes to a close.
Wow, it's going to be really bad for the millennials, right?
Yeah, I would say to everybody, unfortunately, you've kind of lived in a culture where it's for today, borrow from tomorrow today. You've been lulled to sleep with the idea that something called modern monetary theory means you can have your cake and eat it too. You can just print money and spend and spend and spend, which is what our current administration is doing. That is a formula for disaster. And that is, millennials, baby boomers, everybody should understand that right now, get your house in order. That means don't take on more debt. That means reduce debt to the extent you can, as fast as you can, and realize that you should be paying cash for things, because debt in the kind of environment we're going into, debt will be a punisher, not a beneficiary, not a benefit. So everybody should learn to live within their means and be as self-sustaining as they can be.
Okay, thank you so much for your outlook and advice. With all this doom and gloom, do you have any anything positive to say for the future?
Well, sure. For people, I mean, that's why I go through the talk about the new leadership. For the next cycle, if people understand the dynamics of what I just said, it won't be good for index funds, because index funds basically benefited from PE multiples expanding as interest rates declined, because that's a reciprocal. They're kind of inverse to each other. The reverse will happen in the post-bust period, where inflation and interest rates are rising. PE multiples, price earnings multiples, will be shrinking. That punishes portfolios overall, because if you're in an index, generally your benefit is pretty much, it's some of its earnings, but a lot of it's PE multiple expansion. You're going to have PE multiple contraction. So what that argues is the mantra that we've had for the last 25 years of buy and hold indexes because they do better than active managers, et cetera. In the cycle that follows the bust, it will be the reverse of that. Multiples will be contracting, index funds will struggle, and the places to be will be commodities, industrial stocks, precious metals. So what that argues is, as long as you're in the right places, there's a lot of ability to grow your wealth. But if you're in the wrong places, you may not, as I said, you won't, if you're in an index fund and it drops 80% and then only comes back part way, you're never going to see the high water mark you see in the next few months again. So, the real message is understand that markets change and that mantras that are based on the past can come to an end, and it's time to change your approach. And I think knowing that now before it happens can be a real benefit to investors. If they understand what the next cycle is going to look like and they readjust their portfolios, they can have a good time through the decade. But if they stick with what they've done here and they're basically been buy and hold index investors, the next decade's not going to be kind to them. So that's sort of a positive.
How about I don't know if you foresee like a huge maybe like growth in the technology sector, maybe in terms of like maybe metaverse, that might be probably good for the economy, like robots, this kind of thing, Unity.
There will be technological advancements and niches that the growth areas will do fine because they're so growthy that they can outdo the inflation problem. But for a lot of the big growth area that gets its benefit from interest rate reduction and capitalizing that growth at ever lower interest rates, those are going to struggle because it's going to be the reverse. Again, interest rates are going to be going up. But in new areas where there's technological advancement, some of it in the EV area, et cetera,
yes.
Sure, there's going to be places there that won't necessarily, that can do well in spite of not being a commodity or an industrial. So sure, there'll be always those niches, but in a bigger picture way, technology is going to struggle a lot more than it did in this past cycle where it's been really the leader, just because inflation makes it tough on growth.
All right. Thank you so much for your time. It's really great talking to you at last.
Yeah, it's nice to meet you, Cindy.
I hope this was entertaining to you.
Okay, you take care.
All right. So for anyone who wants to reach out, like I said, just reach out to Dave H. Contrarian on Twitter. All right.
Yeah, I've got that investment letter. It's got a cost to it, so it's not free. But if people have an interest or want to find out about it, they just direct message me on Twitter, and I'll be glad to get back to them.
All right. I look forward to seeing you again on the next show, Dave.
Okay, thank you, Cindy, for having me on.
Thank you. Have a great day.
You too.